Hello, and thank you for joining us today for today's webinar. My name is Carrie Minnick, and I'm the partner leading our nonprofit team here at DWD. Susan Berghoff, director and key member of our nonprofit team, will be leading today's session. She will be explaining how the new lease accounting standard and in-kind contribution standard will affect your nonprofit organization. Susan has been with DWD for more than 20 years and has extensive experience serving our nonprofit clients, as well as serving on various boards and committees in our community. Also joining us today behind the scenes is Tyson Moore, supervisor with our nonprofit team. If you have questions or comments that you'd like to share during today's webinar, please use the Q&A and comment box. We will try to address these during the session. However, if we don't address your question, please know that we will respond to you with an email after the session. For those fellow CPAs with us today, this session will count for 1 hour of CPE. There will be a series of 3 poll questions during the webinar. In order to receive CPE credit, you must respond to all 3 polling questions. For those of you that do not need CPE, simply check the I don't need CPE when the poll question appears. Now I will turn it over to Susan to start today's session.
Hello, everyone. Thank you for joining us today for this exciting accounting standards update for leases and gifts in kind. Thank you, Carrie, for introducing us. And Tyson and Carrie are going to be taking questions. So if you have any questions, make sure you use the question and answer box, and we'll try to get those questions answered as soon as we can. If we can't answer them during the webinar today, we will definitely get back with you on the questions with our answers. Today's topic is we're going to talk about the ASU 2016-02 leases, topic 842, and ASU 2020-07 not-for-profit entities, presentation and disclosures of contributed non-financial assets. I'll give you a heads up, most of this webinar is going to be about leases. It's a really big topic, and we're going to share as much knowledge as we can with you so that you can get your leases set up as needed on your financial statement. First of all, we'd like to, I just want to bring a couple definitions into play. I always hate talking in acronyms if you don't know what the acronyms are. So the FASB is a private standard setting body. They're a nonprofit organization as well, and their primary purpose is to establish and improve generally accepted accounting principles, or GAAP, within the United States. So the FASB's one of the things they did a couple of years ago was to revamp the whole accounting standards chart, and we now have the accounting standards codification. The codification is broken into topics. Topic 958 is specific to nonprofit entities. So that if you are a nonprofit, that's where you'd get information on contribution accounting, your net asset classifications, and reporting. The reporting standards that went into effect a few years ago are all a part of that topic 958. But if you're a nonprofit and you have something other than just nonprofit accounting, and everyone does, something like leases, then you'd go to another section of that codification to find information on how to do the accounting for those items. The leases are specifically topic 842. Now, the accounting standards update, ASUs, which is what we're going to talk about today, are issued by the FASB to communicate changes in the codification and changes to US GAAP. So they have really nice little, the ASUs have a nice thing that they put out that shows you why this is relevant, the background information, how they came up with it, and the transition methods and such. FASB issues ASUs every year, usually up to somewhere around 20. And in 2021, they issued 10. In 2018, there were 20. And way back in 2010, they had 29 ASUs issued. The more ASUs, the more changes that are going to go into effect. Some of these changes go into effect immediately. but most are issued 2 or 3 years before you have to actually implement them. So let's talk for a second about GAAP versus the other methods of accounting, which are cash and modified cash basis. The US GAAP are standards that you have to use to do your accounting. And if you use all GAAP accounting, it's sort of like better known as accrual-based accounting. And the accrual accounting, the main thing there is that revenue is recognized when it's earned and expenses are recognized when they're incurred. Unlike the cash basis of accounting, where revenue is recognized when it is received and expenses are recognized when they're paid. The modified cash basis takes your cash basis, then adds some of these little GAAP standards into it. For instance, fixed assets, which is obviously not cash, can be added to your cash basis financial statements for them, or debt or investments at fair value. These kind of things modify the cash basis of accounting. So one thing that we like to make sure everyone understands is that what modified cash basis isn't is using full accrual accounting and deciding that you don't want to put contributions on your financial statements because it messes up your revenue if you put 3 years worth of contributions on there, but you don't actually get the contributions for 3 years. So that's more of a departure from GAAP. So I always like to make sure everyone understands the difference. So as with any modifications, if an organization modifies the cash basis, they have to follow GAAP. So the lease standard is a modification to US GAAP. Cash basis accounting, if you're a cash basis person, this does not apply. US GAAP does not apply to cash basis financial statements. But you have to use judgment if you're on the modified cash basis of accounting, because if you already have fixed assets on the books and the debt that you might have incurred to obtain those fixed assets, it's very likely that part of this topic is going to apply to you, the people who are on the modified cash basis of accounting. And as with any modification, if there's a modification, if you're putting fixed assets on your books, then you need to follow GAAP for fixed assets. If you're putting debt on your books, you need to follow GAAP for debt. So modifications, the modified cash basis of accounting sort of covers both cash and GAAP financial statements. So now that we know where these updates come from and who they apply to, let's jump in. So ASU 2016-02 leases, topic 842, was issued in February of 2016. And that's where the 2016 comes from. It was the second ASU issued that year. We've been waiting for this to go into effect for a long time. It's been around for quite a while. We've been learning about it for a long time. It's just now is when it's going to start going into effect for private companies. The update was issued to increase the transparency and comparability among organizations by recognizing a lease asset and a lease liability on the statement of financial position or the balance sheet, and having additional disclosures about leasing arrangements. There were criticisms about the prior accounting for leases because they weren't on the balance sheet. And the trouble with off-balance sheet items goes way back to the days of Enron. So there were criticisms about the way leases were accounted for, which this ASU fixes. This ASU is specifically for lessee accounting. We're going to talk specifically about lessee accounting. There are some items in this topic that are for lessors, but that's beyond the scope of this webinar, so we're not going to really discuss that today. So who's affected? An entity, anybody who uses GAAP accounting is affected by this topic. So again, as we discussed just a second ago, if you're cash basis, this doesn't apply. The difference from prior GAAP, and prior GAAP is also called legacy GAAP. You might hear it called that in some reading, is that the new GAAP puts everything on your balance sheet and the old GAAP didn't. The operating leases were just disclosed, and this new GAAP is putting it on your balance sheet. So that's mainly what we're going to talk about is how do I get it on my balance sheet? Is it applicable to all leases? Non-cancelable leases over 12 months are the main items that this is applicable for. We're permitted to exclude the lease with a term of 12 months or less. So why not just make all leases 12 months or less so that we can get by without doing this? For the judgment, there's a judgment call there. So I know the amount of time it takes to get a lease put together can be sort of considerable. So there's a time issue. There's a cost issue because usually when you do a lease, you are doing a lease for 5 years, let's say, and your cost is set for those 5 years. So if you had to redo it every month, every 12 months, it's very possible that it's going to cost you more. And then there's that judgment as to whether or not you have the ability to extend the lease. So I always like to say if you leased an office space and spent a lot of money putting improvements into that office space so that it works specifically for you, then are you really only going to stay there for a year? You want to get a couple of years worth out of the amount of improvements that you make. So there's a judgment call there. Is it really only going to be a 1-year lease? There's no scope exception for small ticket items. So if you lease let's say, credit card machine that only costs very little over the course of the year and you lease it for 5 years, that has to be addressed in this, as well as something that you might spend $100,000 for the year on. But the one thing that it doesn't apply to is intangible assets. So if you have entered into a lease to use a fundraising software, cloud-based fundraising software program for 5 years, that doesn't count because it's intangible. And we'll talk about that a little bit later. So the effective date for this lease was originally for years beginning after December 15th, 2019, which would have been December 31st, 2020 year end. But because of there were 2 different extensions moving the effective dates. One was due to COVID, and the other was because FASB decided to change how they did their effective dates. So that actually pushed out the effective date on this topic to years beginning after December 15th, 2021. So for calendar year statement, that means 12/31/2022 year ends. Fiscal years goes all the way into 2023. And we're going to get to why we're talking about this now if it doesn't go into effect until the end of next year, because we're still working on getting done with 12/31/2021. So we're going to talk about that in a little more later. Okay, so the types of leases prior to this ASU, we had operating leases and capital leases. The operating leases were put on as the only thing that operating leases showed up on your finance statements was when you made the payment for that lease every month. Otherwise, it's footnote disclosure. Whoops. Okay. Anyway, my poll did not work. I could not click on it. So I just X'd out of it. So anyway, a capital lease is a lease where you can purchase an item at the end of your lease term, usually for that $1 bargain purchase price. That goes on your has always gone on your financial statements as an asset and as a liability. Anyway, I already said that. So sorry, let me reiterate that now after the ASU 2016-02, we still have an operating lease, but we have a finance lease now instead of a capital lease. They're pretty much the same thing. When we're talking about classifying these leases, first we have to figure out if it's a finance lease, and then if the lease that we're looking at is not a finance lease, then anything that's not a finance lease is an operating lease. That's pretty much how it goes. When a definition says if it's not a finance lease, it's an operating lease, that's always a rough definition. So the same as capital lease, only now both the operating leases and the finance leases are going to be put on the financial statements as an asset and a liability. So there are 4 steps for identifying and recording leases. We need to identify all the leases, measure the terms and considerations, classify them, and disclose them. We're going to talk about all of these steps today. So step 1, identify all leases. So here is the definition of a lease. A lease is a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment, or an identified asset for a period of time in exchange for consideration. So I know that for most organizations, you'll only have a limited number of leases that are specific to a lease agreement, like office rent and a copier lease. Some contracts, though, may have hidden lease components in it. So it's really important to get a copy of all the contracts that your organization has entered into for the year to make sure that there's not some component of a lease within that contract. So I made up an example of maybe what might have a hidden lease component, a contract that might have a hidden lease component in it. Let's say you've entered into a contract that lasts for 3 years and you're paying someone to do training for your organization. They're going to come in once a month for the 3-year period and do training. And in order to do their training properly, they bring in this really big whiteboard that is all computerized and puts it in your conference room and leaves it there for the duration. Says you can use it if you need to use it for items that other than when that individual is in there doing training. Well, that gives you the right to control the use of that piece of asset for that 3 years, and you're paying for it, so there's consideration. So you've got a lease that's embedded in that contract. Those are the types of leases that you have to make sure that you also put on the books based on this topic. So you have a contract, and within that contract, there are 3 possible components. We have a lease component, which is the portion of the contract that meets the definition of a lease. So the easiest things to think about is copiers, rent, either your building or your office space, and whatever other kind of asset that you might be needing to lease. Within that contract, there could also be a non-lease component, which is other provisions that require the lessor to pay for, the lessor to transfer goods and services that the lessee is paying for. So if you have an office lease, there could be security, there could be common area maintenance if your office space is in a building with numerous other organizations. There could be property management and maintenance agreements. So these are all non-lease components. And then the third possible component is what is called a non-component, which is administrative stuff. Taxes and insurance are non-components. A lot of times you'll get a separate bill for your copy machine to pay the property taxes on it. Or if you are leasing office space or a building, you might be required to pay taxes and insurance on the property that you're leasing. Those are non-components, and all of these components sort of go together to make up the contract. There is a practical expedient, new word, new definition, which is an accounting policy election that's allowed by the FASB that allows for not separating the lease components and the non-lease components, because it's very possible that you have a lease and it says you're going to lease this and we're going to do security or maintenance, and not split out how much the value of that maintenance is in regard versus the value of the property that you're leasing. So this practical expedient allows you not to have to split that out. Otherwise, there's judgment calls as to whether or not how much this is versus how much this is. You don't need to put that non-lease component on your books as a part of this topic, but this practical expedient allows you to do that. Electing that this practical expedient will increase the asset and the liability that you put on your books, because there's more of an asset than there might be if you don't have that non-lease component on the books. We'll talk about that a little bit later as well. So when it comes to identifying all leases, one of the next steps is to identify the asset. So the asset should be explicitly identifiable by a serial number, which is what your copy machine would have on it, a VIN number. So if you're leasing a vehicle, you have a specific vehicle that you're leasing, and the VIN number tells that. Also, if you're leasing a building or an office, the address or a GPS location can show you exactly where it is that you're leasing. So it has to be an explicitly identified or implicitly identified, so which is above and beyond this. I don't think there's too many people who will have to deal with that. And it could be that you're leasing a portion of a larger asset, which in the case of, let's say, office rent, you could be an office in a big building. So that is a part of how to identify the asset. And this is why cloud-based software is not included in this, because it is not an identifiable asset. One of the examples that I've had in the past is because, let's say, QuickBooks, you use QuickBooks Online, which is one that pops in my head, and you've agreed to use this for 3 years. Well, the Intuit people, as they upgrade their QuickBooks, will automatically upgrade this. So you might not, when you log in one day, it might be a whole different software than if you log in the second day because of changes that might have been made. So you don't actually have the capability of making changes to that. So that's why it's not included in this particular topic. And then the period of time. Again, we just talked about this. It applies to lease terms of greater than 12 months. So I have an example here. And a part of this example, let's see if it fits the definition of a lease. So we have a contract. Yes, they have a contract with a supplier for 5 years to use tank equipment over the course of that time period, and they are paying for it. So do we have an identified asset? Yes, we have tank equipment. Period of time is 5 years. Consideration is $15,000 per year with an increase of 2.5% each year. So do we have a lease? Yes, we have a lease here. So this is going to have to be recorded on our books using the lease accounting topic. So step 2, measure the term and consideration. So let's talk about that. The lease term is made up of the non-cancelable period plus any renewal options that will be exercised. So if you have an option to renew something for 2 more years, if it's reasonably possible that you are going to do that option, then that would be a part of the lease term. And then there's termination options that will not be exercised. And then if the lessor has an option to extend that's only within his control, that's added as well. So again, there's a little bit of a judgment here. If you lease something for 3 years and you have, let's say, an option to extend that for 2 more 3-year terms, you have to make a judgment call as to are we more than likely going to extend for that whole term? If it's like an office and you're a growing company, do you really want to cut yourself in for 9 years when you might outgrow where you are? So there's a judgment call there. Consideration is payments that you're going to make on the asset. So in the case of our aquarium equipment, it was $15,000 a year. So plus an increase of 2.5%. So those amounts that you're going to pay every year are the payments related to the use of the asset. Plus, we need to add any other fixed payments. So if there's any other fixed payments that are a part of the lease, you would add those in. Any other variable payments that depend on some rate of index, we would add those in. And then we'd remove any incentives, cash incentives, or anything that's payable to the lessee, to you as a lessee, to enter into this lease. The only main example I can come up with that is a lot of times if you lease, let's say you're leasing a vehicle and they say, oh, come lease this vehicle, you'll get a 3-year lease and we'll give you cash back of $2,500 to lease this vehicle. That then would be subtracted from the actual consideration of the lease. Then we have to take into account the discount rate. So the discount rate is the rate implicit in the lease. This is rare. Maybe if you're leasing a vehicle, but if you're leasing a copy machine, the capability of finding out what that rate is extremely rare. But if there's nothing implicit in the lease, you have the option of using an incremental borrowing rate, which is the rate that you would be charged to borrow funds to purchase the same asset for the same amount of time. So you go to the bank and say, I want to buy this copy machine over time. The rate that they charge you would be your incremental borrowing rate. And then you also can have the option of using a risk-free discount rate, which is like a T-bill rate, which is normally much lower than any other rate. We also now have another practical expedient that we can use. And this is to be able to use a risk-free rate for all leases, unless it is implicit in the lease. It allows you to pull up the T-bill rate for 3 years, for a 3-year or 5-year or 6-year or however many years that you need, and use that for all of your leases. It makes it easier to calculate. There's only one rate that you need to use. The main drawback is the rate is much lower in most cases than your incremental borrowing rate would be, which causes you to have a higher asset and liability on your statement of financial position. So the main drawbacks with that has to do with maybe some loan covenants that you might have, and we'll talk about that in just a little bit. So back to our example. So we now have all the information from this example that we need to measure the term and consideration. So the term is 5 years, consideration $15,000 a year, increasing at 2.5% each year, 6.5% incremental borrowing rate. They had an initial direct cost of $750, and they are getting a cash incentive of $2,500. We also have no renewal options, so we don't have to deal with that. And the transfer of ownership is none. You don't get to keep the equipment at the end of the lease term. So let's see what we can do with that. So initial measurement. This new topic puts an asset and a liability on your balance sheet. So the lease liability is equal to the present value of lease payments not yet paid. And then your right of use asset, which is your asset, is the lease liability plus any prepaid lease payments, plus any initial direct costs minus the lease incentives. So we're going to have two new general ledger accounts that we're going to use, or there may be more if you have more different types of leases that you might want to present separately. Your asset account, which would be named something like right of use asset, is a long-term asset in most cases because your lease is going to be a long-term, it's going to be greater than 1 year. Your liability would be named something like lease liability, and it's a long-term liability account. But whatever you name these accounts, make sure that they make sense to you so that you can look at it and say, oh yes, that's what is in there. So, you've got building, that's a building. So if the right of use asset is what you want to use as a name, fine. Make sure everybody understands what that means. So here's our example, our NFP aquarium example. So we have our lease term and consideration over in the in this first box. It's $15,000 a year for plus a 2.5% increase a year. And so I've figured all this out. So the total amount that they're paying for this aquarium equipment is $78,844. So first you have to figure out what are we going to pay over the course of all the years that we're going to have this lease. And then we can figure the lease liability by doing the present value of lease payments not yet paid. And in this case, and I'm going to show you something a little bit later about this. In this case, it's $65,328. So we take this lease liability amount here and we add the initial direct costs, which in the case of our example was $750. And we subtract any lease incentives and in this example, it was $2,500. So our right of use asset is $63,578. That's the asset that's going to go on the asset section of your balance sheet. And then the lease liability of $65,328 is going to go on the liability section of your balance sheet. The difference is cash, and I put a little AJE down here. So the right of use asset is debited, the lease liability is credited, and then you paid $750 and you got $2,500 back. So you actually had a cash transaction of $1,750. So that would be what you would need to use to set up your lease account at the beginning of the lease term. So we're going to talk a little bit later about how to amortize those leases going forward. But first of all, let's go to step 3, classifying leases. So again, we're going to talk about we need to classify, we need to determine, do we have an operating lease or do we have a finance lease? In the case of our example, there was no buyout, so it's not a finance lease, so it's an operating lease. The operating leases and finance leases are similar. They have similar initial financial statement impact. So but it's a little different going forward from there. So I put together a little thing here that shows how they're different in the financial statement presentation. So the operating lease, you would have your right of use asset and your operating lease liability. Whereas for a financing lease, you could either have a financing lease asset, or a lot of times we just put it in with your fixed assets. And then you would also have an accumulated depreciation account that goes along with that fixed asset. Then you'd have your financing lease liability, which in the past we've always just titled capital lease it's a note that is payable to someone, so it's a liability. On your statement of activities, the lease expense is going to be determined on the straight line basis. So whatever that $78,000 or the $65,000 that we had as an asset, we're going to split that by 5, and that's what's going to be expensed on the straight line basis on the statement of activities as lease expense. Now, the financing lease, on the other hand, we now have amortization expense or depreciation expense for the fixed asset, and then interest expense for the financing lease liability. The change in that liability is going to go to interest expense. Statement of cash flows, the operating lease, and shows up in operating activities on the statement of cash flows as cash paid for lease payment, and that's where you'd put the cash paid for lease payments. If you're doing a direct cash flow statement, it would definitely be a line item on your statement of cash flows. The statement of cash flows for the financing lease, your interest payments is operating, whereas your cash paid for the principal is financing activities. So your financing lease is a little more meaty. It actually shows a few more things on your financial statements than the operating lease does. So when it comes to classifying leases, we're going to talk about a little judgment that is required. So considering electing practical expedience, that excludes short-term leases. It allows you to elect the risk-free discount rate and to not separate lease and non-lease components. There's professional judgment that you need to determine the lease term and renewal options, the fair value of the underlying leased asset, because believe it or not, even with whether it's an operating lease or a financing lease, they don't always tell you what the fair market value of those assets are when you enter into a lease. And then in remaining economic life of the underlying asset is also required when figuring out how to classify these leases. So step 4, we're down to disclosure. We have new qualitative information in part that is going to be needed to be disclosed. So what I mean in part is that all of the information that's already required to be disclosed is still required to be disclosed, but there's some additional disclosures that need to be made as well. You have to, if you have some leases that you've entered into but hasn't started yet, we have to talk about that in the footnote disclosures. We have to disclose if you use practical expedience, if you elected those as a part of the leases, we need to put that in your disclosures as well. There's new quantitative information that's needed. So we have to talk about cash paid for amounts included in the measurement of these liabilities. So how much cash did you pay out? That's part of the measurement. There's supplemental non-cash information on lease liabilities that we need to talk about. And then weighted average of the remaining lease terms and weighted average of discount rates. Well, those are beyond the scope of this webinar, and it probably is only applicable to someone who has multiple different types of leases when we're determining the weighted average of these leases. So there's some additional disclosures that are going to be required as a part of the lease topic. So again, let's talk about significant judgments that were going to be needed. So there's judgments that are going to help determine whether a contract even contains a lease. The allocation of consideration between lease and non-lease components, the determination of discount rate, those all are judgmental. So if an organization is when the organization is determining whether or not these leases are operating, financing, how much we're going to put on as asset, how much we're going to put on as liability, and you've made judgment calls on those things, important thing to do is to write those down. And so that, because it's a judgment call, it means it's not necessarily right or wrong, but it needs to be documented as to how you come up with the judgment that you did. This topic is for leases only. So if you have an unconditional promise to give the use of a long-lived asset, such as a building or the facility, that you get to control the right of the asset and for a specific period of time, but there's no lease payments, this is not a lease. This is a unconditional promise to give, and you have to use contribution accounting to record this particular type of activity. If you have a below market lease, so you have somebody's let you use their property for less than the market rate, you're going to have to do a little bit of both. So the consideration that you do have to pay is covered under this topic, and the part that you don't have to pay to get you to fair value is a contribution. So it's covered under the contribution accounting. And then you could have a fully donated lease. So this would be recognized as a contribution receivable and income when you find out that you are getting the lease. And then it would be a donor restricted net asset that you would release over the life of using that property. So again, you have to sort of, everything that you have that you might think is a lease, really need to look at it and determine, is it a lease? Is it a promise to give? Do I need to bifurcate both a lease and a contribution accounting? So important. So the transition, there's two options for transition, and I'm not even going to bother reading this first one. You can read it, but it more or less what it says is, if you are doing comparative financial statements, you have to go to the beginning of the first year presented and present these things in the same manner for both years, which means if you have a December year end and it's showing the 2021 and 2022 on your financial statements, you're going to need to apply the changes to January 1st, 2021, which means anything that happened in 2020, you're going to have to deal with anything, and then start from that balance and add 2021 and 2022. That's, if you have a lot of leases, could be a little bit time consuming. You can also, the other option is to figure the change from the beginning of the year of adoption, which in this case is going to be, you're going to adopt this. It has to be adopted in 2022 for calendar year end 2022. So you would only have to then go back to January 1st of 2022 and in determining what the initial value of this assets and liabilities are, which helps a lot because you only really have 1.5 years, 2 years to deal with instead of 3. So this is why we're talking about it now. If you wait too long to figure out how many leases you have, whether the leases need to be addressed, you have to go, if the farther you wait to do this, the more difficult it's going to be to make sure you have everything, that you've found everything. There are practical expedients, again, that you can adopt to simplify the implementation, but you have to pick all or none. So if this is an all or none situation. So if you pick the practical expedient, you won't have to reassess whether existing or expired contracts contain leases. So that's the hard part. If you have to go back to 1/1/2021 or even earlier than that, you have to look at all of the leases that you have to see if maybe there's something inside that lease that should be or all the contracts that you have, you have to see if there's a lease in there. Well, this practical expedient says you don't have to do that. Also, there's no need to assess existing lease classification. So perhaps you missed the fact that there's a capital lease in that you should have had in there and you had it as an operating lease. So you don't have to reassess those classifications. And you don't also have to reassess initial direct costs, because there's very possibility that you paid that direct cost, you're not utilizing it as a part of your lease asset. So if you pick those practical expedients, you don't have to do any of those things. So the impact of this lease topic can be extensive if you have loans that have loan covenants. So if you, and I'm sure that there's some nonprofits out there that have loan covenants that like for debt to equity ratios and stuff, if they do have loans. But if an organization is required to meet certain financial covenants as conditions of debt or credit agreements, this standard could put you in violation. So if that's the case, you need to start working with your lenders now and have them and yourselves understand the effects on your loans for this new lease standard. You can consider modifying existing debt and loan agreements to avoid these violations. We have what's called a frozen gap clause that could be used. This clause provides that if there's changes in financial ratios because of changes in gap, it's not going to, you won't be in violation of the financial covenants. So if that's written into your loan, that's a good thing. That means any change in gap won't cause you to be in violation of your financial covenants. We also have what's called a semi-frozen gap clause, which requires the parties to renegotiate the loan covenants if there's a change in gap. So that's something to think about going forward. After you adopt 842, you may wish to get with your bankers and modify the covenants. Continue to use frozen gap or semi-frozen gap clauses as you enter into new loan agreements. So how do we prepare for the changes to this lease topic? Policies and procedures. If you choose to use one of the practical expedients, you should update your internal policies and procedures. If you don't have policies and procedures about this, it's time to put that into play. You may want to communicate with individuals who enter into contracts at your organization to make sure that the finance department gets copies of these contracts. I know that's happens a lot. There's the one part of your company that enters into all your contracts, but doesn't always let the finance department know about it. So need to make sure that everybody's on the same page. We want to read and review all contracts, determine whether the lease has incremental borrowing rate, determine whether the lease is a financing lease or a capital lease. And for organizations with multiple leases, especially determine if the use of one of those practical expedients will save time. I want to make a list of all leases, noting the asset, when does the lease go into effect, the asset type, the lease term, the discount rate, or the T-bill rate, or the incremental borrowing rate. We want to figure the present value of lease payments and direct costs paid as a part of that lease. You want to make a list is great, and we've put together a spreadsheet that we can give you at the end of the webinar that starts out with a couple of examples of a list. The very top of this area right up in here is a list that is, when does it commence, what kind of asset category is it, what kind of asset is it, what's the term, and such. And then I put together tabs that go with each of these that and I have functions in there which should be that can assist you in determining what is the present value of this lease. So this particular example here goes with the aquarium supplies that had some numbers in some of the earlier slides that shows here's the present value of these leases. So the total lease liability, the initial direct costs are added and subtracted, and this is then the asset. So this section over here shows on 1/1/2022, which is when this lease went into effect, this is the entry that you need to make to put it on your books. And then as you pay out your lease, this then this 12/31/22 line shows you how to reduce, is more or less the journal entry that you need to take it off your books. You're going to end up with a lease expense of $14,650 in this case, because we have this $1,750 that is now being recorded as an offset to lease expense because you actually received $1,750 in cash. So instead of having put it in as a revenue item, it's now an offset to your lease over the course of 5 years. So that'll be made available at the end of the seminars along with the slides. So if you're having an auditor review, you can assist your auditor by making all contracts and leases available. Give us a list of the list as discussed earlier. Make sure that we know how you calculated everything. And just, it's best if you do the entry and let the auditor audit the balances. But if you need assistance, we can assist you with that. If you're not having an audit, we just have, let's say you're just doing a 990, and you can, again, provide the list as discussed earlier. And if you haven't recorded the leases, we can, again, help you with that when the time comes. Now that any questions that anyone had that we would like to try to address prior to going on to the next topic?
Nope, I think we're good. I think you probably would agree that the biggest thing that these clients can do right now to get ready for the leases is gather their leases, making sure that they have agreements for all of those leases so they can be ready for the year end.
Exactly. Okay, so our next, real quick, our next topic has to do with disclosure for contributed non-financial assets. It was issued in September of 2020, and its main goal is to make those non-financial assets more readily consistent from one organization to the next. So just real quick, I know we only have a few minutes left. So a contribution has not changed. It's still an unconditional transfer of cash or other assets to an entity. And the financial asset is a non-physical liquid asset. So cash, investment. So if someone gives you investment, that's a financial asset, cash equivalents. So a non-financial asset is an asset that is not a financial asset, one of those really great definitions. But a non-financial asset would include land, building, equipment, use of facility or utilities, materials and supplies, intangible assets or services. So anything that is not liquid, that can't be turned into cash in a really quick manner. The main provision of this is how it's reported on the financial statements. So you have to present contributed non-financial assets as a separate line item on the statement of activities, apart from contributions of cash or other financial assets. So I put a little example here. This is a statement of activities. This is just the very top of the statement of activities. So the support and revenue items that we have here is contributions. So that would be all your liquid cash contributions. Then we have a separate line for in-kind contributions of non-financial assets. And then we keep going with government grants. You could have program service revenue. You can have all sorts of other things that then follow. but mainly it shows how we're separating the non-financial assets from the contributions. The disclosures that are required then mainly we need to show if you get a non-financial asset, what category of the what category is that going to be in? So is it a program, a management, general, or a fundraising? We're supposed to disclose if the assets were sold during the reporting period. So somebody gave you this non-financial asset and then you sold it. Do you have a policy for that? Describe the program that the activities, if you kept the asset, used it, describe the program or other activity that they were used in. The policy, if you have one for monetizing rather than using the non-financial asset. So if you have a policy that says if somebody gives me a car, I'm automatically going to sell it and use that in wherever I need it to be used. We need a description of any donor imposed restrictions on the use of the non-financial asset, a description of how that asset was valued, because somebody gives you, let's say, a 1969 VW Beetle. There's a judgment there as to what the value of that particular non-financial asset is. So we need to say how we figured out what the fair value of that asset was. And then the principal market that you use to arrive at that fair value. So as I said, if you got a VW Beetle that's older than you are, what market did you use in determining what the value of that particular asset was? So those are all disclosures that need to be made. Here's an example of a disclosure. So this one shows that $15,000 worth of in-kind contributions are made up of equipment, food, and legal services. It goes on to say, what the fair value technique was, that the equipment, food valued at the wholesale prices, legal services are valued at the rates that law firm charges. Donor restriction in use, we say the food is restricted for the use in the downtown shelter. Everything else is not restricted. The organization does not sell in-kind contributions. So it goes on and shows what it is that we just discussed and how those items might be reported as a disclosure in the financial statements. If you use DWD to prepare your financial statements, you may already see this. We do the same type of presentation for our non-financial assets now. We break them out by, was this used in program? Was it used in admin? Was it used in fundraising? So we already do that part, and it's sort of a picture instead of words. So if we do it in a picture, we don't have to put the words in. So a picture is worth 1,000 words, as they say. So we already do this for many of our nonprofit clients that have in-kind contributions. Okay, this effective date, it's effective on June 30th, 2022 year ends and thereafter. So June 30th, if you have a June 30th year end, it's effective this year. It's effective December 31st, 2022 as well. And it's to be applied just on a retrospective. So if you're doing comparative financial statements, you only need to apply it to the most current year presented. Any other questions that we might want to discuss on regarding this topic?
Nope, I don't think we have any other questions.
Okay, well, if not, then I want to thank everyone for coming. I have a screen up that shows where our upcoming webinars, the dates of our upcoming webinars, where you can get on there and register for those webinars on our nonprofit education page on our website. Also, slides and videos from this webinar, as well as other webinars that we've done, are also available on that same nonprofit education page on our dwdcpa.com website. And I want to thank everyone for coming, and hope the rest of your day is very productive and enjoyable.